Welcome back. I'm Lindsay Williams in Cape Town. This is Investment 360. This age-old, which seems like an age-old debate between developed markets and emerging markets is continuing, particularly as Janet Yellen, the new chair of the Federal Reserve, is speaking at this moment, and whatever she says will affect the emerging markets, their bonds, their currencies, and also their stock markets. In the studio with me to talk about emerging markets versus developed markets is Yolande Naude, who is the head of research at Citadel, based in Cape Town. Yolande, you see some value in emerging markets at the moment, which is sort of flying in the face of conventional wisdom, I think.
Yeah, it's a true contrarian approach at the moment, and we understand our view is contrarian, but it's very strongly based on specific opinions on fundamentals in the economies, on what we see with the health of corporates in emerging market countries, and also in terms of valuations.
Yeah, valuations of course being the key, and there are certain countries I know that you think are cheaper than others and certain that are more expensive. Before we go back to Johannesburg, just give us an idea of the cheap ones and the expensive ones.
Russia is by far the less expensive at this stage. It's selling at a PE of 5 and a dividend yield of 3.5. In addition to that, Brazil isn't expensively priced, and China also looks like value. And on the expensive side, South Africa is very expensively priced relative to other emerging markets, and Mexico is also not a cheap story anymore, and that's a fascinating one because their economy is actually doing fairly well, but it looks as if their stock market has already discounted all of that.
From when we're expensive, South Africa, in the emerging market world apparently.
What about the other African countries, Yolande?
Other African countries have similar kind of exposures. And the valuations aren't cheap at this stage. It's also a lot more risky if you go into the frontier markets because of governance and political issues. So investors who distinguish between frontier markets and emerging markets should be careful when they invest in frontier markets. In our opinion, there's a lot of value in emerging markets at the moment. You don't have to go to the frontiers where there's lots more risk.
When you come to the determination of what country is cheaper or cheap and not, do you adjust upside to fair value? Do you adjust that for structural value creation like ROEs, for instance? And if you do so, and even if you don't, I guess, the question is, what kind of sectors within these countries do you tend to find value in? If not sectors, what kind of fundamental specifics are you seeing in these countries where there are pockets of value, or where pockets of value lie?
In terms of valuation, we look at various valuation measures. We look at price to earnings ratios, trailing earnings and forward earnings, look at price to cash flow, dividend yields, and also price to book levels. So if you look at a combination of all of those factors combined, and you equally weight them compared to 10 years of history, for example, then